Hello and welcome, What the Finances, to another episode of the What the Finance podcast, where we talk to experts to help gain a greater understanding about what is happening in the world of finance, investing, and markets. So, in today's podcast, I'm happy to welcome Joe Olashugba, who's a macro observer and author of the Market Macro Hub, which is a great blog talking about everything happening in the macro world. So, Joe, thanks for joining the podcast.
Pleasure. Thanks for having me, Anthony.
No problem. So, I guess my first question: how are you holding up in these crazy markets? So much is happening at the
Oh yeah,
moment.
honestly, great question. It's been turbulent, but it's probably the second time around where I'm actually experiencing such a call it turbulence in the markets. First one, of course, COVID, because before then it was realistically the GFC, and up until now it's been two back to back. So, yeah, holding up pretty well. Things on your end?
Yeah, definitely. I don't know about. I'm thinking for you as well. I was way too young and during the
Yeah,
GFC to remember
yeah,
anything. Like you hear stuff,
exactly.
but you just don't know. So now it's actually experiencing it
Yeah,
where we can be investors. So, in terms of your, I guess, investing, I know that from how I know you, it's mainly on FX. Is that really what you
yeah.
focus on? Is there anything else?
Yeah, definitely. It's more on the FX side, but I'm moving more to a global macro purview. Of course, you have to study it quite a bit to understand that equities are something which is quite a long way from being mastered. But once you have the full understanding of FX to then equities to bonds, you get that cyclical understanding of, okay, this is how this asset class performs during this tightening or this period. So that's currently where I am now. But FX is my main priority at the minute.
Yeah, it's interesting. So you're looking to understand more about the things that are influencing, I guess, the macro, but at the same time,
Yeah,
FX and yeah, how that
correct.
moves markets.
Correct. Yeah, definitely.
Interesting. So, we mentioned that there's lots of crazy stuff happening at the moment. What are the major, I guess, macro trends that you're currently, interested in or keeping an eye on? I know
Yeah,
there's a lot at the moment.
there is. Honestly, I think it starts from the Fed meeting. That was, pretty interesting to say the least. And what I can tell from that, Jay Powell was very committed not to monetary policy, but to the citizens of America to really, force, hey guys, we're really taking inflation seriously, and this is our main priority. And as usually, I'd read the SEP, that's the summary of economic projections, which they release after all the minutes and, of course, all the press releases. And when looking at it, you can see that the Fed will probably have to start cutting in 2023. If you're looking at currently this year, how the growth forecasts are looking, I don't see the Fed actually forecasting and actually being able to implement that 130 basis point hike on top of the neutral rate, as the SEP projected to be. I think that's somewhere around 3.8%. They see the federal funds rate in 2023. I I am seeing them cutting before then, just because, as you know already, every single leading indicator for the US economy is getting weaker and weaker and weaker. But a macro trade I'm definitely eyeing up is potentially a long on the yen, which we can get into that later on. I'll explain why.
Yeah, that's very contrarian, I guess, compared to what we're seeing
Yeah,
at the moment. So I
yeah,
guess we'll stay with the Fed.
yeah.
Um, so, they're obviously talking about continuing to increase interest rates, but you think that are they going to get to the point where they basically just break the markets or break something and they're going to have to cut? Is that what you're thinking will happen?
Agreed. Agreed. Definitely. It's one thing for the Fed to reiterate time and time again they're going to hike rates, and they have. Up until now they have been successfully hiking rates, but they've been hiking rates and we're not at the neutral rate, which people are failing to remember. Up until we get there, we're going to see very, very minimal. I doubt we'll see something as big as a 50 basis point hike as soon as we reach the neutral rate, which is somewhere around 2.5%. Once we get to 2.5% in federal funds rate, we're going to see slower hikes progressively. And as the economy and economic, really, I'd say, circumstances and conditions get tighter and of course worse, I don't think the Fed are going to hike into, even further weakness, because usually we tend to see the Fed hike into strength, which is always a good thing. We're seeing the Fed hike into weakness, which is a flip in scenarios.
Yeah, definitely. It's crazy to think. And, we've already seen, I guess, indicators in the UK, GDP
Yeah.
growth, going negative, EU, all these other things. And I think
Hmm.
market sentiment as well recently was the worst it's been in 80 years. I'm not sure if you saw that as
Exactly.
well. So there's all these indicators, but I guess the issue for them is inflation is still high. So do you think even if they hit that neutral rate and inflation is high, do you think continue to go at the rate they are or? So I know it's a tough
Honestly,
question.
it's a sticky one. Yeah, it's a tough question because the inflation we're experiencing, it's not a demand-driven inflation, it's supply-driven, and now we're at a second stage where it's gone from non-discretionary goods to no, so it's gone from discretionary goods to now non-discretionary goods. Before it was on cars, which realistically the average person isn't buying a new car every single time. Now it's on the things which we need day to day to operate. So once we see the Fed get to neutral rate, if inflation still is peaking, I think they're still going to continue to hike, but I think the aggressiveness will be much, much, much less than what we're seeing right now, with 75 basis point hikes and 50 basis point hikes. I think we're somewhere around the 25 basis point and below kind of range for further hikes.
Yeah, and that would make sense. And I spoke to someone called Hugh Hendry recently, and he's saying that he thinks it's looking similar to, I guess, potentially 2008, where we could just see demand destruction and, there's a massive drop off in
Correct.
demand and inflation massively decreasing. But then, just my thoughts, and I guess maybe it's because I'm always trying to counteract my trades and what I'm thinking of.
Yeah.
I'm thinking as well that there may be the potential that because we've seen maybe a K recovery in the economy, even though many people are struggling with inflation, there may be quite a large upper class that's still continuing with the demand and still want the items. So that it could continue with inflation. There's that balance between I understand demand destruction, but I understand it might
Yeah.
not be as quick as we think. I don't know if you have an opinion on
Agreed.
that.
I'd say, I mean, similar to the point you mentioned about consumer confidence, also business confidence, that's at the lowest as well. So I don't think it's just, the people on the lower end of income that are being affected. I think it's something which everyone's feeling, employers, everyone. As you know, when you're running a large firm or running a large hiring firm or tech-based or whatever, you hiring is predicated on the availability of credit. Credit gets harder to access whether you like it or not. You could be an S&P listed company, a FTSE listed company, you still feel the pain, and especially tech firms, they're feeling the brunt of this kind of force going down north of 10, 15, 20% now. So I'd say it's a sticky one for everyone in each area.
Yeah, I agree. I guess you could say Coinbase, Netflix, all these companies, they're really,
Yeah,
laying off people as well. So as you said,
yeah,
it is starting to squeeze a lot of different industries.
definitely
So
agreed.
you mentioned the yen. We won't get there yet, but is there any other trends that you're maybe watching?
You know what? I think long. If you have been fair play to you, but long, the UUP ETF, which is a dollar ETF, basically, just investing in that. It tracks a dollar against I think G10 pairs. That would have been a great trade. Of course, anything where we're hiking rates, economy is not looking good, you're going to go back into your safe havens, and the dollar's been a primary, bet which has played out. So I'd mainly say long dollar, and of course commodities. Who wouldn't say commodities? That's been the play of the year. Realistically, everything from gold to, I wouldn't say gold, more energy based commodities have been absolutely riding through the roof. So commodities, dollar, and the yen, I feel like that could be a play we may see in the next half of this year, 2022.
Yeah, we have seen that. Everyone loves to say like the dollar's dead, but when this stuff happens, we see
Never. Yeah.
that people continue to go to the dollar. And I think it is going to be quite concerning for many of these emerging markets, especially the one that
True.
import dependent on commodities. They might have high debt because if the US dollar is, if the interest rates are so high, it means that these countries either have to increase interest rates as well, or they're going to have high inflation. So it's like that
Exactly.
balance, isn't it?
Yeah, that proxy. And if you don't increase rates, you're just going to have a bunch of traders placing carry trades on your economy. It's not ideal for them. So yeah, they are following suit. I think even Swiss central bank are even hiking rates. So if these guys are moving, then it's kind of indicated that everyone needs to move now with monetary policy stance.
Yeah, they used to be what, negative 0.25 or something like that,
Yeah,
maybe
it
more.
was even more. Yeah, I think it was more actually.
Yeah, I think they're going to try and, because they have like lots of equities as well. I think they're going to try and sell those. But anyway, so we will go to the yen, I guess. And, you
Yeah.
said you're potentially long. There's been a carry trade, as you may, I'm not sure if you can maybe explain that, and then maybe why you think it could be a good long going into the future.
Sure. So, in other words, in layman terms, carry trade. If you're in FX, you're looking at a country where, let's say, America, and of course, America and Japan. America's got rates roughly at 1.75%. The yen is negative. Japan, for many reasons, low growth, low inflation. If you're an investor and you can see clearly there's a difference in interest rates, that differential is where you seek that opportunity. So, what you would do simply is you would more or less bet on the US economy, go long US economy, and of course risk the short the yen. And of course, yields wise, 10 years, 10 years, you can see that yeah, the US have got their 10 years somewhere around 3%, if not higher. And the yen, Japan, is actually sitting negative due to their yield curve control. So it's pretty clear as day to see why you'd want to be long the dollar and of course short the yen up until now, and that's kind of gone into the FX rates, which is why we've seen the yen go from, I haven't got my chart on me, but you can probably see it's gone from 2022 massive rally into the 140s levels we haven't seen for 10-20 years. So that's a trade which is clear as day. But the reason I would want to be potentially long the yen in the upcoming quarter two is, once again, every single central bank is moving towards a tighter stance, and Japan, they're going to feel it. We've already seen their 10 years slip above that peg, and then of course the BOJ had to rush keep it below that peg of 0.25% or 0.25 basis points for the 10-year yields. But I feel like due to the pressure Japan is feeling on even their domestic economy because of the yen weakening, and we know Japan is a net import of goods, so it's never good, never ever good for Japan. The BOJ may not, I doubt they're going to go from yield curve control to let's scrap it. They're probably going to go something like, okay, yield curve control is at 0.25%, maybe let's push it up to 0.5%, 50 basis points, or maybe let's push it up to 0.75%. So that's where I think the BOJ may move to, and as we know, traders will react heavily on that, and a long in the yen is going to be inevitable. So I don't think the BOJ. So my bet is more or less betting that the BOJ, Kuroda, cannot hold on to that negative stance any longer, and that easing cycle they've been in for a number of years.
Yeah, that's interesting. I was listening to someone. I'm not sure if you heard of her, Lynn Alden, she's very well known in macro, and someone really good to listen to. She was saying that if they let it slip or even move the goalposts, that people will lose faith in the BOJ, and they'll think, if they move the goalposts now, they're going to do it again in the future. Do you think that could almost make it even, worse for Japan, and maybe push your trade up even higher? Because if you think about it, if people think that, sorry, you go.
No, I mean, you're completely right. I think, a central bank, they have two main things: monetary policy and the confidence people place in them for, them sticking to their charts or their policy tools. If the BOJ were to, remove that peg from the economy and from that, 10-year debt obligation, that would be a massive weakness longer term for the yen, but short term a massive spike in volatility, and of course for us a massive rally on the yen, and the dollar of course would have a bit of a kickback. But I think long term dollar still bull. But for that second half of the year we're moving into, you probably want to be looking at longs on the longs on the yen.
Yeah, it's interesting. So in terms of your maybe investment philosophy, are you more like the swing trader, I guess, or how would you define it? Yeah.
Sure, I'd say for trades like this, I would definitely want to be more on the swing type of thing, just because you're going to catch majority of the move, and that's when you can play, of course, the macro thesis. Because if you're intraday trading, you don't really need to know what's going on with 10 years, monetary policy. But if you're looking at a longer term trade, 3 month, 6 month hold, even longer, because that's where you get to be in a swing trader, then you need to understand what's really going on. But day to day, I prefer to just be in and out, intraday. But for some trades, you need to just take some time and help kind of hold on.
Yeah, definitely. And in terms of, I guess, you mentioned a few indicators you're watching. Are there any more like key indicators that maybe if something happens, then you'll change your opinion, or?
Yeah, I think for Japan, it's probably bad. I have a bias that this has to happen. So I feel like my conviction for that is probably a bit too high, but what would make me change at the minute? I can't see what would make me change my stance for going long on the yen, unless we see massive strength, unless we see ISM for US start picking up and manufacturing data starts to pick up, and we start to see inflation top, and then we start to see that would kind of make me reevaluate my thesis, okay, of where we're moving to. But up until then, as long as we have a bleakening economy in the US and we have the same thing, low growth, low inflation in Japan, I think the trade's probably going to play out sooner than later.
Yeah, it's interesting because it plays out if the US cut rates, or it plays out if the BOJ take away yield control.
Exactly.
So those are sort of the two, I guess.
One of the two is going to happen.
Yeah, exactly. Yeah. We would say. Yeah, that's really interesting. So I guess, we've seen the potential for, people were saying transitory inflation over the past few years. It didn't happen. So I think what you're suggesting is that you think we will, next year or so should peak, and then from there it will go down. Is that sort of what you're thinking?
Yeah, I feel like I definitely wrote something here in my notes, which I'll just pull up. But from the last hike, I found that after the research, from the last hike that the Feds do to the first cut, it's usually around about 8 months. So if we're looking to hike all the way until end of year, where we're going to be roughly, I think 3.4% or somewhere near that, can the economy hold then? Probably not. Is growth, I think people are now, analysts are now re-evaluating their growth estimates, and it's going negative now for firms. So even for the US as well. So realistically, I don't see the US holding, rates high and then pushing all the way up to, 3.8%, which, look, if you're comparing that to the terminal rate, that's 130 basis points above it. So that's, very aggressive. Up until we go above 2.5, we're still accommodative. Although we're tightening to an accommodative, place neutral rate. Up until we go above that, then it's pretty tight. So I can't see the Fed holding rates there. I think we're going to have demand destruction probably before we have that 3.8% sometime in 2023.
Yeah, it's interesting. And you mentioned how you're focusing more on the macro. Are there any, I guess, looking away from currencies, are there any other macro trades that you're looking at? I know some people trade bonds. It's a risky game, but anything else or no?
Yeah, you know what? I'd say for now I'm keeping it pretty simple, just because I need to navigate this next cycle as best I can, rather than kind of diving into bonds and getting into other stuff. The most I'd probably do is get some exposure on a dollar ETF, holding something which is pretty certain.
Yeah.
As long as we do, of course, strengthen, when we do begin to see anything different, you can just hop on the other side of it realistically. But up until then, 10 years, use that as a proxy, continue watching employment data, and of course PCE is what the Fed are looking at. But now they're moving towards head-on inflation, so I'll just keep my macro narrative based upon those few but certain tools.
Yeah, that definitely makes sense. And I think one of your recent articles on the market macro hub that we mentioned before, and I think people should check it out because it's really, I really enjoy the articles. You're talking about the 3 stages of a bear market. So I'm assuming that you think that potentially the US, maybe other stock markets are going to go into a bear market. So maybe can you explain what those 3 stages are?
Sure. So the 3 stages for me, when I was kind of going through that, it was very much, first of all, I got it from a thread on Twitter, which I really like. So for those who aren't on Twitter, I know a lot of you are, definitely kind of get on Twitter because there's so many good people you can follow. But for me, I'll just go to that title there and I'll read out the first 3 and explain to exactly kind of where I sit and why I'm pretty confident we're in stage 2, not stage 3. But stage 1, as you know, it's the unwinding, and that's, I think it's happened Q1. When we see that the outlook gets bleaker and bleaker and bleaker, what we tend to do is people tend to kind of capitulate. And even in cryptos, you can see that happen across the board, where everything from your alternatives to your mains, BTC, ETH are down heavy. Equity, same thing. Nasdaq has been bleeding since the start of the year, and that's step 1, the unwinding. And for me, step 2 is more or less the forced capitulation, which is what we've had for the last, I'd say, 2 months, when every single Bloomberg TV, every single market feed is just telling us bad information. And I feel like stage 2 is where we are, because stage 3 is just dead silence in markets, and no one's moving, no one's buying. There's no, risk tolerance. Every single person is just holding on to cash, trying to preserve their portfolios. But that's where the bigger trades begin to unveil itself. I have a few friends who are actually long equities already, which you may call it, early, but there's value in quite a few names just because the earnings and of course the metrics and evaluations have come to a sort of normalization compared to where they were a year ago. But the three stages for me were definitely somewhere in stage 2. Stage 3, Q4, Q1 2023, I see that happening. But that's a quick overview of how I view the 3 different stages.
Yeah, no, that's super interesting. And I guess, you mentioned there finance news, Bloomberg, all those things. Why don't you like it? Why don't you like what they say?
It's it's the same story. Before, when I was just growing up in the whole macro world and FX world, you watch these stuff and you think, wow, these guys are giving really good recommendations for stocks to buy. But then you kind of trace their words, the time they were saying it, to the stocks and the performance, and you realize that their job is just to keep you aware of what's going on. It's not to tell you where markets are moving, because if it were to tell you where markets are moving, everyone would be rich. So I'd say take it with a hint of salt, just because these guys are here to entertain us. It's as much entertainment as you can get for finance markets. So don't hold your life on Bloomberg.
So looking under the surface, I guess, and actually at the indicators, statistics, all that stuff to understand what's happening rather than focusing on what they say.
Exactly. I think it's important for people to actually look at the source. For example, if you're looking at the Fed or you're looking at the BOJ or the BOE, rather than trying to go to a news outlet or a random individual in the markets, try go to the Fed official website, read its SEP, read its monetary policy minutes, read it. Take time to read it, try to understand it. The first time I read it, Lord knows I didn't understand every single word because it's quite complicated. But the more you read it, the more you're able to interpret the data from its original point, and then you can develop more clearer and more confident, outlooks into the wider economy. For example, you might have seen the most recent Fed dot plot, which is pretty interesting. 2024, you can see, a range of the FOMC members. It's ranging from 2 to 4%, the thesis, and that for me was a key indicator that there's a real lack of consensus in the US economy moving on the long run. Usually we'd see Fed dot plots are pretty clustered together, but if you're looking at 2024, it's such a wide range. So that shows you that even the people put in charge to manage markets, to manage conditions, they're not certain in where the US economy is moving to. And the reason I speak so heavily about the US economy is because we're all linked from China to US to Europe. As you know, China's the leading indicator for global demand. If China slows down, America will. We've seen China ISM slow down. Now we're going to see US ISM slow down. If US slows down, Europe will, and just full interlock.
Yeah, it's very interconnected, isn't it? That's one thing I think for commodities, like I am quite bullish on some of them, but then at the same time, the slowdown in China, slowdown in the infrastructure, potentially house building as well, is another thing. Because if you think about the demand that they've had for copper and all these, the last super cycle. So I guess that's one thing that concerns me about commodities. I don't know if you have a similar opinion or.
I agree. The thing about commodities,
I'm just throwing opinions at you.
I like it because it's keeping me on my toes. But the thing about commodities, it's as long as inflation's going up, commodities will go up. That's the thing. Yeah. Until inflation slows down, we're not going to see commodities slow down. So we've had that run in commodities, like you mentioned, copper. We've had probably every single commodity there is, have a rally. Especially that we've got the added pressure of Russia and Ukraine going on. That doesn't help at all. So commodities, I do see a slowdown. I feel like we missed a trade realistically. If you're entering now, you are pretty late. Although I was listening to I think a podcast the other day, and it was saying there's still time to add gold exposure to your books, because relative to other commodities, gold is fairly valued and it's fared pretty well even during the Fed hiking, because gold tends to not perform so well when Fed hiking, just because it doesn't yield any actual gain to yourself, but it's done pretty well, still holding around about the 1800 level. So that could be something you may want to get yourself exposed to if we do see the Fed start to cut in 2023, because then of course everyone runs to the gold bullion.
Yeah, that's interesting. I'm talking to a few silver bulls as well in the coming in coming days. So I'll have to get their
Yeah.
opinion on it. But I think for me as well, maybe I'm looking at the things that are definitely going to happen. So I guess transitions to renewables. So like lithium, obviously battery, cobalt, all those
Mhm.
commodities. I don't know if they're fairly valued or maybe they've already had that run up. But I think that's one thing
Mhm.
I'm definitely going to look at in the coming months to see.
Yeah.
Is there still an opportunity? Because they're so in demand. There's not enough supply of it for to power the whole world. I guess that's my hypothesis, but I need to do more
Yeah.
research on it.
Oh, it's worth it. It's really
Yeah,
worth it.
definitely, it's time. And I think one thing when you were mentioning like how we're seeing capitulation. If you look at crypto,
Yeah.
I think it's really happened there. We've seen some stable coins depeg
Yeah.
and collapse. We've also
Yeah.
seen, I don't know if you've seen block fires. They're basically insolvent. So they're trying to get a bailout.
I think I read it.
Yeah.
Yeah.
So I guess we're seeing it maybe in the most speculative assets. Is we're seeing
Agreed.
capitulation. And I guess, do you think it could go into other companies as well?
You know what? Crypto's something which I'm no expert on, but we can always have a view on that.
Yeah.
Crypto had its massive run up, which is great for everyone, but unfortunately that was during a time where cash was so easy to get your hands onto. The Fed were pumping money into every single person's pockets. They were simply just buying up Bitcoin, Ethereum, and all these altcoins. Um, its bleed has been one to remember this year, and I think as we go into the second half of the year, we're going to see a lot of these hedge funds, Three Arrows Capital, you might know them. They're massive when it comes to the crypto space. Start to offload the books, and as we see that, even further room to the downside for crypto. But moving that to equities, there's still space to go down, yes, but I'm starting to move my narrative to potentially looking long on particular names and particular sectors. That I haven't yet decided, but when everyone's looking short, that's usually the time when you should be looking. Usually, not always. Usually, the time you should be looking to find some good names, which may be trading, below par or below that, intrinsic value.
Yeah, I think there are some great companies out there that I'm keeping an eye on as well. And I think that for
Yeah.
me, the risk is that. Sorry, I'm going to go about my opinion again. If you
Yeah.
get
Let's go.
a few of those hedge funds, if they get margin called and they can't pay it, then the banks are just going to sell it. So I guess the
Yeah.
concern is if a few of those blow up, like we saw, um, there was one in the US last year, and that was 20 billions worth. If that happens again to a few of
Oh
them, that
yeah.
can sort of create
Yeah.
further. Yeah, I don't know. It shows you my
That
mindset.
was.
I'm quite negative and conservative sometimes. Looking at the risk.
Yeah, I think to be fair with you, I was definitely short S&P like as a perspective and view for the past 2 months, just because I couldn't see anything moving, upwards. But if I'm short S&P, that's on a S&P level, short an ETF
Yeah,
or
yeah.
something like that, not short the whole every single sector. But moving forward, I would want to start changing my perspective to looking for opportunity. Risky, definitely, but I think it starts with the smaller, trades moving from FX, and then of course, if FX is showing you something, so where there's some value, then of course other markets, other areas may actually, kind of start to give a bit of a hope as well.
Yeah, definitely. That's some great insights. So, Joe, thanks so much for your time. I think we've gone all over
Pleasure.
the place, haven't we? All over the world.
Yep,
So
yep, everywhere.
that's the FX and the macro lifestyles, and you have
Yeah.
to think about everything. So, I guess what is one message that you'd like listeners to take away from our interview?
I'd say patience is key, but drawing your context and your research from the source is even more important. So yeah, I'd say definitely patience, but also know where you're getting your data from, know where you're doing your research from, and know how you're going to build your macro thesis or macro viewpoint in the near and of course long term.
Yeah, awesome. And sorry, I got another question. Do you think?
Sure, let's go. Yeah.
Do you think? So you mentioned there that it takes some time to learn. Do you think that's just
Yeah.
it's just putting the time and putting the effort in, learning the terms, and then after 6 months, a year, you'll be better, and then just continuing to do that?
Agreed. Agreed. I think with macro, oh I can't even pronounce it, market macro hub, my newsletter, it started off as something where I just personally in my own time just write a quick summary of what's happened today, the main things, whether that's Boris and everyone's trying to vote him out, or whether that's the pound hiking rates and or anything. I just write it down. Then eventually, I just love the research, started doing more, started developing a bit more understanding about how markets are interconnected, and from there just pushed, I think, a year later into market macro hub, and it's still ongoing, still progressive, still learning, because you never stop learning, especially when we're kind of young in the markets. We have to just take it in our stride.
Yeah, definitely. And I think I've been listening to a lot of people, and they say it's one thing getting the macro picture right. It's another
Yeah,
thing actually making money off it. So it's
true.
getting the macro picture right as well as getting the trade right to make
Yeah,
money off it, which is almost
exactly.
harder, I think.
It's true. It's true. That's the hardest part, the execution.
Yeah, definitely. So Joe, thanks again. So you've mentioned a newsletter, which I definitely recommend people
Yeah.
subscribe to. I think that's on Substack. I'll put it in the description. Oh, it's not Substack. It's another website, but I'll put it in
It's
the
a
description.
Scriber, yeah. It's a new platform.
Yeah, awesome. I'll have to have a look at them. And is there anywhere else that maybe people can follow you to keep up to date with your work?
Sure, sure. Definitely reach out to me on LinkedIn. That's just my full name. Even Instagram as well. I'm pretty active, trading wise, speaking about macros, newsletters on definitely my Instagram as well. Just my full name as well. And yeah, hopefully we'll be back
Yeah, I have to get you back in next few months to see what's
for
happening.
sure.
But yeah, Joe,
Only
thanks
if the
again.
yen trade plays out.
Oh yeah, otherwise,
Yeah,
no, we'll get
only
you
if it
on, and
plays out.
I think
Yeah,
it's always good to if you make a mistake, understand why it happened.
exactly,
Yeah,
exactly,
we all do it in trades, and I think risk management, everything like that, it's important to understand that.
exactly.
But yeah, Joe, thanks
Definitely.
again.
Pleasure, pleasure. Thanks, Anthony.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.